this out. Bell Point's chief strategist, David Nelson, Gibbs Wealth Management president, Aaron Gibbs. And Aaron, let me start with you. Okay, let me set up this scenario. What if I told you a company posted results, beat on revenue, slightly beat on revenue, crushed the earnings by 53 cents, 24% above consensus, that gross margins went to 26 from 23, they hiked their forward their guidance. What do you think the stock did? A, unchanged, B, down 6%, C, up 6%. Okay, because what I just described to you, Aaron, was Polaris. So how do you deal with that? You're a shareholder in Polaris. How do you deal with that yourself as a professional in your own portfolio when companies do everything right and the stock goes down on earnings?
Yeah, and it's even more baffling because their beat was even bigger than the prior quarter, and they've actually beat top and bottom line for 5 quarters in a row. I mean, this is a quality company, just like what we talked about the Jack Welch constantly beating earnings, and so it is baffling. And I think what we have to take a look at is that. Part of it is that obviously earnings estimates really are a lot less meaningful. The beat rate used to be about 73% before the pandemic, and now it's almost 84%. So the expectation really is that you have to beat, and you have to beat by a lot. And so it's sort of a wonder of why, after 4 quarters of this 85% beat rate, Wall Street hasn't gotten their act together and started raising their estimates. And that's another separate issue. But with Polaris, I think you've got to stick to your guns. It is a great stock. It is still growing. It was a little valued in April, but it's a good company.
So before I switch to David, I want to just squeeze this in with you. I mean, we're a quarter into an earnings season already. This has had to have happened to you already. Do you say, okay, in my own personal view of this, I'm going to stick with the stock, focus on fundamentals, and ignore the emotional knee-jerk reaction that right now, for the most part, is to the downside?
Yes, I would. And I think you also take in the bigger picture of the stock is, if the stock's already up 27% year to date, it's okay if it has 3 quarters of consolidation. I'm going to stick with the stock because it still follows my fundamental reason for getting in.
Right. And of course, David, there are times when the quality of the results can be called into question. Certainly there are times when guidance is disappointing. Let's talk about UPS, for instance, right? They did beat the street. Revenue's up more than 10%. But the U.S., the revenues are up overall, but the U.S. revenues were actually up less than anticipated. Operating margins, the guidance for that was 12.7%. That was below the current quarter, the 14% that we just saw. So those shares are getting smashed. In a situation like that where there is some obvious hair on the number, and if you're a long-term investor, do you grind it out? Do you grit your teeth? Or do you bail out saying, well, you know what, it's going to be a while before they rebound?
I didn't see anything glaring in the quarter. Comps were difficult this time around. Most analysts had this pegged at about, flat volume growth, and they came in actually down 4%. And that's probably the pressure that you're seeing on the shares. And in a vacuum, you'd probably want to load the boat here. But part of this is the sentiment, resounding around China. And it's not lost on investors what's going on in emerging markets. Both this company and FedEx, these are logistics companies and deal with supply chains around the world. And people are starting to question cross-border trade. And in that environment, people are going to sell the shares and step to the sidelines. This isn't being lost on me as a FedEx shareholder. I'm getting hurt today in sympathy with this.
But you're not selling your FedEx.
I'm not selling my FedEx. They had a great quarter, and to Aaron's point, and to your point, you forgot D&E up 10%, down 10%, because that's the kind of volatility we have to live with in a market with so much derivatives exposure going into an earnings report.
David and Aaron, we've got to leave it there. I wish we had more time, but I think we touched on something that was so critical, and I think it's a learning experience for our audience as well. So we'll come back to this from time to time. On a day like today, extraordinarily frustrating. Thank you both very much for your expertise.